Cap rates are probably the single most referenced metric in grading a commercial real estate building, and they are full of do's and don'ts, pros and cons, and it's probably the most misunderstood metric. Maybe the first number a lot of investors look at, but it's really the last one that they should rely on. Welcome to the CRE Podcast, where we break down how to find your first commercial building without having to wait decades to get it. I'm your host, John Heisler. Today, we are going to talk about understanding cap rates. So if you've thought about getting into commercial real estate at all, you have at least heard the term cap rate. And even if you think you understand it, I would highly encourage you to listen to this episode, and I may make it a two-parter, I'm not sure yet. Because you can go way in depth in these. It's one thing to understand what it means. It's another thing to understand how it applies to commercial real estate and how you can apply it to how you buy commercial buildings. Now, if you're an expert, then maybe skip this episode. But if you are trying to get into commercial real estate or you've got a couple buildings and you want to get better, this is a great episode series to fully understand this at a high level. So cap rates are probably the single most referenced metric in grading a commercial real estate building. And they are full of do's and don'ts, pros and cons, and it's probably the most misunderstood metric. I'll give you an example. I was talking to somebody a couple weeks ago, and I showed them a building that we had just bought, and they asked me, what cap rate did you buy it at? And that seems like a simple question, but that's kind of a loaded question. And if I had answered it simply in just one number, they would have drawn a conclusion about that building that may or may not be true. So we're going to talk about that. Honestly, cap rate may be the first number a lot of investors look at, but it's really the last one that they should rely on. And I'm saying that, and you may be asking, well, why should I even care about the cap rate at all? And it does have a lot of importance for buying, selling, refinancing, we're going to talk about. So let's start with what a cap rate actually is. So if you don't know, cap rate is short for capitalization rate, and it's one number in the most foundational formula in commercial real estate. And there's a couple, if you remember back to your algebra days, capitalization rate equals net operating income divided by your purchase price or the value of the building. Those things are interchangeable. To say this another way, the value of your building or the purchase price should be the net operating income divided by the capitalization rate. That's the same formula, just shown two different ways. They're both incredibly important. So what does this mean? Let's go grade school level and just start with simple numbers. So if I have $100 and I give it to you and say, hey, in a year, I need you to pay me back $110. We all understand intuitively that over that year, I earned 10% interest on my $100. I gave you a loan of $100, right? The other way to think about that is the $100 is the value, the $10 is the net operating income, and the 10% is the capitalized rate of my $100. So let's extrapolate that to a building. So if you have a $1 million valued building that generates $100,000 in net operating income a year, then that building is a 10 cap, or its capitalization rate is 10%. So why does this number exist, and why is it so important in commercial real estate? Because what's fundamentally different about commercial real estate compared to residential is, not always, because you can be an owner occupant, but we are all buying commercial real estate for the same purpose. We are buying it as an investment. Compare that to residential, there's a whole bunch of reasons you could buy a residential building, only one of them being an investment. But in commercial, we're all trying to buy investments. And if you're buying an investment, to understand if it's a good investment or not, you need to be able to compare it apples to the best of your ability to other investments, both other asset classes, both the same asset class, so comparing one industrial building to another industrial building, but also being able to compare it to other outside investments outside of commercial real estate. So being able to compare it to stocks and bonds. In the part two, or the later part of this, we're going to talk about how commercial compares to bonds. And so if I paid cash for $1 million industrial building and it made $100,000 a year, I bought it at a 10 cap. Now I need to compare that same $1 million. If I put that into another building that makes $150,000 net operating income a year, that would be a lower cap rate. And actually, let me figure that out. I need calculators for all math. So I'm doing $150,000 divided by $1 million, and that is a 15 cap. So that building is essentially getting me a 15% return on my money. So that's a better deal than the 10 cap. Now, those numbers aren't reality in commercial real estate. So let's start talking reality. But first, the cap rate is not a measure of, so it's called levered or unlevered. So a levered return is when you put a mortgage on a building. So rather than giving $1 million cash for that industrial warehouse, if you go get a $700,000 loan and put $300,000 down, now you're out of the realm of cap rates. Like the cap rate does matter, but some other metrics, which we can talk about in a later episode, matter more to use to figure out if that was a sound investment. And cap rate is designed to compare buildings apples to apples, regardless of mortgage rate, because we could all get different mortgage. I could have better credit than you, or you could have better credit than me. We get different rates. I could go to a local credit union and get a lower rate, and you went to a national company. There's a lot of different reasons that rates are different. And so this helps you compare buildings without the mortgage. So who sets cap rates? So there's a market cap rate that you may or may not know in every single market you've been in and in every single asset class. And then even further, there's different cap rates for a class A, B, or C product within those asset classes. And so there is a market cap rate for all of those things. And if you are going to purchase, it is your job to find those numbers out. And they move up and down. They're not perfectly the same number forever. Now, they do move slowly. It's not like the stock market where they can dump a week after some big event, hopefully. So they are a bit slower, but they do. So what affects them? Risk. So a Class C building is felt to be riskier than a Class A building in all asset classes. And so those demand a higher cap rate. If you think about that logically, an investor wants a higher return for a riskier product. Now, if you think all the way on the other end of the spectrum, the buildings with the lowest cap rates in commercial are what we would call absolute triple net nationally accredited tenants that are A+ rated. So think Target, Starbucks, Dollar General, things like that have 25-year leases. If you can get into one of those, then that cap rate that they are trading at, that people are buying and selling them at, is a lot closer to the bond market, which we'll talk about, because the risk perceived in that building is incredibly low. And it's the closest thing in commercial real estate to real mailbox money, where you don't do anything. And so that's why that is typically trading at a lower cap rate, which means if for that $1 million, you're going to make a lower net operating income because your risk is lower. Another reason cap rates move up and down is growth, potential growth in rent and potential growth in an area. So if an area is expected to improve, if it's a booming area, then people are wanting lower cap rates compared to if it's a stagnant or declining area. Cap rates move not in lockstep. They're not directly related to interest rates, but interest rates do affect them. Think about it in the buying and selling side. If I can get an interest rate of 7%, but a building is trading at a 6 cap rate, can I really cash flow in that building? Not really, unless I buy it for cash and don't get a loan. Or if I get a loan at such a low percentage of the purchase price that it finally cash flows, which means I need more cash. And so that's difficult for a lot of buyers. And so they're not buying lower cap rate buildings all the time in a high interest rate environment. And that's the current market that we're in. As capital flows in and out of asset classes and in and out of commercial real estate compared to stocks and bonds and other things, that affects cap rates. And that's more at the institutional level. That doesn't affect the $1 to $5 million commercial buildings that I recommend that people go after when they're new. But it will eventually affect them, but not in the same way as it affects a 700 unit Class A apartment complex. So we did a whole episode on asset classes you should definitely check out. I did not get into specific cap rates per asset class. But what I can tell you is that absolute triple net is kind of the lowest cap rates in the commercial real estate world. And they're trading maybe slightly higher than the 10-year Treasury yield for bonds. And we'll get into at some point the entire reason behind that. But think about the lowest cap rates in commercial real estate at the time of this recording in the 5 to 6 range are trading are absolute triple net. So I would say the next thing up is multifamily, in particular the higher class multifamilies trading in the 6 range. As you get into the class B, maybe 7. I'm seeing class C in a lot of markets honestly being a free fall right now, and a lot of them are trading in the 9 to 10 cap range. But that's very, very recent. So if you're watching this recording at a different time, this could be dramatically different. But you can think through the perceived risk there is a big reason for that. So a Class A building is perceived to be less risk. It could be trading right now in the 6 cap range. Now, a couple years ago in 21, 22, in a lot of really, really high perceived growth markets, think Austin, Dallas, places like that, those were trading in the 4 to 5 cap range. And, that has slowed down significantly. Office, as you could imagine, post COVID with the work from home and the uncertainty around it, the cap rates have increased dramatically. I would say the more Class A products are in the 8 range, unless it's medical office. Medical office is still on the lower side, just the perceived risk is much lower. And then Class B and C office is kind of free floating. I would say anywhere from a 9 cap all the way up to 12 cap plus, depending on how risky the building is. Retail is all shockingly all over the place. If we're talking strip centers, you could get a really, really strong Class A all the way down in the 5-6 range. And then Class B and C going 7, fluctuating 7 to 9 range, depending on area and all that. And again, this is all massive generalities. Go talk to brokers, research the cap rate in your local area to understand it for the asset classes that you're looking at. Don't take my word for it. In industrial, I'm seeing same thing, kind of Class A 6 or 7, and Class B, C kind of 7, 8, maybe up to 8.5. I'm not seeing much above 9 plus in the industrial space just because it's stronger. So really, really good exit purchases for industrial right now. So let's talk through some common mistakes people make when they're looking at cap rates. Comparing a 5 cap apartment complex in the nicest area in Nashville, which has been exploding for over a decade, compared to a rural part of Tennessee with 18,000 population, not even hardly the same product. So you can't compare those things in any way, shape, or form. The area is dramatically different. And obviously that's a big example, but the area matters tremendously. And even sub-market of the major city is important to really understand. CoStar has some good reports on this. It is a subscription, and it's a bit pricey, but it's definitely worth it if you're going to do this full time. Now, I bought several buildings before I had a subscription, so you don't need one, but it's incredibly helpful. If you're going to stick to one local area, start to meet and know some brokers in that area, and they'll help you a bunch understanding the local area. Let's talk about how to use cap rates in practice. The first part is entry cap rate, or the cap rate going into a building. A lot of people will ask you, like I said at the beginning, what cap rate did you buy that building at? And that question only matters if you're buying a completely stabilized product. So if you're buying a Class A apartment complex that's 95% occupied and the NOI has been stable for multiple years, then that is a building that the cap rate matters, what you bought it at. But if you're buying a property that's 50% occupied and the expenses are out of control and the property management is not doing a good job, the cap rate you buy it at almost doesn't matter. I mean, it does, but it more matters, what is that NOI now? Where are you buying it at? And what can you make it worth in the future? And then what cap rate could you sell it or refinance it at? So that's the more important cap rate metric in that scenario than what you've bought it at. I'll give you an example. I have bought several products where the going in cap rate was well under market, 4, 5, 6% if you wanted to calculate it. And then I've bought vacant buildings where you can't calculate the cap rate because the building's not making any money. It's actually losing money because it has expenses. So it has a negative NOI. It doesn't have a cap rate. So it's not really a great metric for unstabilized products at all. Should you look at it? Sure. But I look at it more as, where am I going in? And then when I have a stabilized building, what is my cap rate? What kind of return are we getting on our money? And so when we own it, I want to see it well above double digits. And this is where it gets confusing for people. Because it almost doesn't matter what you buy it at unless you're buying stabilized. If you're buying stabilized, I personally want to buy at least a point and a half, or 2 points above what market cap rate is. Now, it's not going to be easy to go find those products above that, but if you can, that's obviously a great deal. But the whole point to 2 points above, doesn't really factor if it's an unstabilized product. So I care more about, we had a building, we bought it at a 4 cap, but then once we stabilized it, it was spitting off a 12 cap of NOI and revenue to us. And so that's an incredibly good deal. So I'm looking at the ones that I can make the cap rate, force the cap rate through increasing revenue or reducing expenses, or both, into the double digits plus very, very easily. So that's what we're looking for. So if I'm making 12 plus cap money on it, but the market cap rate for my asset class is a 7, that's a really great space to be in, because I've generated a bunch of value. That building is worth a 7 cap, but I'm making money at a 12 plus cap. So that means I've injected a bunch of value into the building by increasing the revenue or reducing expenses. So I increase the NOI. That's where I want to be. But the building is still worth whatever the market cap rate is, 7 cap or whatever. Now let's talk about that for a minute. What a building is worth. How does that help you? Well, if your goal is to buy a building with your cash, capital partners cash, bridge loans, or even just unstabilized loans, and then stabilize the building and then refinance and pull all your capital back, which is a very, very powerful play in commercial, you get to, on your appraisal, the building is worth the income divided by the local market cap rate. So in that situation, you just added a bunch of value, you can pull all your capital back. So that's a great play to get to be in a lot of buildings long term with not a whole lot of capital committed to them forever. Also, you could of course sell, and theoretically, your building is worth whatever the NOI divided by the market cap rate is. Now, here's the catch: I already talked about, we're in a high interest rate environment right now, and the demand is not quite where it used to be for a lot of these asset classes, maybe industrial excluded. There's still buyers out there, don't get me wrong. For every single asset class, there is buyers that do this professionally that are buying, and there's mom and pops still buying. So don't think there's no buyers. There's just less than there used to be, and they want deals, just like I want a deal. So even if market cap is 7, they may be looking to buy it at an 8 or an 8.5, or heaven forbid, a 9. So you better model that in your underwriting and make sure that you can still make good money even if you sell it at a higher cap rate than what the current market shows. And so I always model it. If the market is a 7, I always model it all the way up to 2 points, maybe even 2.5 above the market cap, and see where my break even point is and see how profitable I am in each one of those scenarios and really understand it at a high level. By the way, that is called stress testing your deal, and it's extremely important. We'll do many episodes on underwriting, but you want to stress test your deal on all things. So what if the occupancy never hits 90+%? What if it gets stuck at 70%, 80%? What's my break even in occupancy? What if I don't get market rent? What if I get 20% less, 30% less? Where's my break even there? What if I never get my expenses down to, what if they're 30% above what I'm projecting them at? What if my renovation budget is 50% over? What if it doubles? Thinking through all those different scenarios, including what if I can't sell at a 7 cap, I got to sell at an 8.5 cap. Understanding all those scenarios and where you still are okay and where you're not is extremely important before buying a building. I should have covered this at the beginning, but I kind of forgot to. NOI, if you haven't figured out, is revenue minus expenses. And simplified version, it's all revenue, not just rent. Anything else you're doing to make money, late fees, whatever, chargeback stuff, that's revenue. Expenses is obviously all your expenses: taxes, insurance, repairs and maintenance, common area fixes, landscaping, trash, cleaning, whatever you got going on, utilities, of course, that you're paying. All those are your expenses. So those two numbers subtracted is your net operating income. That's extremely important to understand about your building. Now, what is not in an NOI is your mortgage. Just like we talked about with cap rate, everyone can get a different mortgage. And so we use NOI and cap rates to compare apples to apples between buildings. And so we don't want mortgage messing that up, because that's not in it. So key takeaway from this episode is the best investors aren't just buying at, hey, what cap rate did you buy it at? They have a deep understanding of what cap rate they're buying at going in, but more importantly, what value can they inject, and what cap rate will it be worth when it's stabilized, and then where can they exit it at, and how can they leverage those things to make the most money for themselves and their investors. All right, let's talk homework. If you're just getting started, go to LoopNet or Crexi, find a listing that interests you, pull the net operating income if it's on there, even ask the broker what it is if it's not on there, look at the value of the property and figure out what cap rate they're trying to sell that building at, and ask yourself, based on what I said and your knowledge of the local area, does that make sense or not? Now, what if you bought that building at a 30% discount? Would that be an attractive cap rate to purchase it at that time? If you're a little bit more advanced or you want to take this farther, do what I talked about earlier and ask yourself, yeah, maybe the cap rate is 4 right now, but if I go bring the rents to market, what cap rate, how much money would I be bringing in income after I get it to that value? And then if I sell it at market cap rates in the future, what might that building be worth at that time? All right, next episode, we are going to get into Treasury Yields and bonds and how that affects cap rates. I think it's really cool. At least it's cool to me. It'll probably be a shorter episode, but a little bit denser. All right, so that's the show. Stop watching other people do deals and go write an LOI. If you need help, come see us at CRE-Playbook.com. Until next week, it's John Heisler signing off.